Silver investors, they told you the APMEX shortage is over, that shipping is back to normal, that the panic is gone. But in the same breath, they quietly slipped out the most important sentence of the year, that in this so-called normal market, a single dealer was so overwhelmed it took a full month to clear orders while COMEX inventories kept draining and miners were getting 30% more than the screen price. I'm OG John AG, and in this video we're going to talk only about silver. What APMEX's "We Fixed It" email really reveals about physical demand, how COMEX vaults and Shanghai rule changes line up against that, why Hekla's premium sale price and Samsung's pre-buy are the real silver benchmark, and what it means for anyone still trusting a $70, $80 quote on their screen when the real fight is happening in warehouses, mines, and government policy. Segment 1. APMEX says shortage over, but read the fine print. Let's start with the one line everyone forwarded and nobody read. APMEX's CEO Ken Lewis sent out an email saying, shipping times and customer service have returned to normal. If you stopped there, you think, okay, crisis over, everything is calm. Now the parts they hope you skim. Over the last month, APMEX faced unprecedented demand, record prices, and supply challenges that put pressure on the entire industry. Weekend order volume was running 7 times normal. They were forced to limit the product range down to 31 core items, often only 21 actually in stock. Estimated ship times had to be pushed out by 4 business days across the board. They had to ramp up customer service staffing by 25% just to keep up. And that went on for weeks. So when APMEX says back to normal, what they really mean is, we finally dug ourselves out of the hole the last wave of demand blew in our warehouse wall. They do not say, the global silver deficit is over. Physical supply has magically expanded. Next time will be easier. They're just saying, for now, we caught up. In a market where COMEX inventories are lower than before, Shanghai stockpiles are lower than before, and miners are switching to direct deals, that is not an all clear. Segment 2. What a month-long backlog tells you about real demand. Think about what has to happen to break a system like APMEX. This is not a mom-and-pop shop. They run a national-scale logistics operation. They have multiple warehouses, their own minting lines, and decades of experience writing cycles. For them to get 7 times normal weekend order flow, to the point where they literally can't ship on time for a month, you need more than a few panic buyers. You need a structural shift in who is buying and how much they want, at the same time that APMEX was choking on orders. COMEX registered inventories were sliding under the 100 million ounce mark. Shanghai was pushing physical into backwardation, paying a fat premium to get metal now. Hekla was reporting realized prices 30% above COMEX because industrial users were going direct to the mine. That's 3 very different channels, retail, exchange, and miners, all hitting the same wall. There isn't enough metal at the official price. APMEX catching up just means that wave is over. The next wave comes into a system where vaults are thinner, Asia's policies are tighter, Western governments are starting to set price floors, backlogs will be back. Segment 3, COMEX. Less metal, same promises. While retail was waiting extra days for their boxes, COMEX's numbers kept moving in one direction. Across recent reports, you see registered silver sliding from the mid 160 million ounce range down through 100 M into the high 80s on some recent days. Single-day withdrawals of 2 to 3 million ounces, with almost every major vault hit at once. JP Morgan, Brinks, Asahi, CNT, HSBC, StoneX. At the same time, open interest in front-month contracts represents multiple times the available registered stock. That's like a bank with 100 million in actual cash in the vault, 360 million in demand deposits, and a long history of everyone not showing up at once. It only works as long as most people roll their contracts. Most winners take cash, not delivery. Most industrials source metal somewhere else. APMEX's month-long backlog tells you one part of somewhere else is already strained. Hekla's 30% premium tells you industrials are already bypassing COMEX, so every ounce leaving COMEX now has fewer alternate routes to re-enter the system. Segment 4, Shanghai, and the quiet rule change that protects their metal. Now add the East to this picture. Shanghai's futures and spot markets have stocks down over 80% from their 2021 peak. Physical prices trading far above Western quotes. The Chinese response was not a blog post. It was a rule change. In delivery and pre-delivery month, speculative positions get automatically set to 0 unless you are a pre-approved hedger with quota. That does 2 things. It pushes tourists out of the front month. It protects critically low stockpiles from being stripped by casino games. So while COMEX is still happy to run a 3.5 to 1 paper-to-metal ratio 9 days before first notice, Shanghai is effectively saying, no more games. If you aren't here to take or make delivery, you're out of the front of the curve. Add that to APMEX's backlog and COMEX's drain, and you get one clear theme. The places that actually need metal are tightening rules and paying premia. The place that mostly prints claims is still pretending price is the story. It's not. Inventory is the story. Segment 5, Hekla and Samsung, the benchmark nobody quotes on CNBC. Now zoom back to the supply side because this is where the mask really slips. Hekla, 135-year-old miner, reported last quarter that the average COMEX benchmark for silver was about $54.83. Hekla's realized price was $69.28. That's roughly a 30% premium. At the same time, Samsung signed a deal to prepay for 100% of output from La Preciosa for 2 years, locking up silver before it ever hits the market. No ETF, no meme, just a global electronics giant writing a big check to make sure it gets metal. Why would they do that if COMEX was deep, London was loose, and every dealer was fully stocked? They wouldn't. They're acting as if future silver availability is uncertain. Paying a premium now is cheaper than scrambling later. Put Hekla, Samsung, and APMEX next to each other, and you get a simple, brutal message. The real clearing price for substantial guaranteed silver is not what your broker app shows. It's higher, and it's being set in quiet, direct deals, not on the COMEX ladder. Segment 6, the illusion of all clear after a crash. Look at the timing. Massive engineered smash. Silver from around $121 down to the 60s in a day. APMEX backlog and shipping delays peak into that chaos. As price stabilizes in the 70s, APMEX says we're back to normal. On the surface, it reads like, crash scared the tourists away, market is healthy again. Underneath, the reality looks more like, crash temporarily slowed one lane of demand long enough for one dealer to clear the queue, while structural deficits, policy shifts, and vault drains quietly got worse, because nothing that created the stress has been resolved. Multi-year supply deficits still in place. COMEX registered still near multi-year lows. Shanghai stockpiles still way down, rules now stricter. Governments have moved from denial to intervention. Price floors, strategic reserves. You don't fix that with one nuke and a press release. You delay the reckoning. Segment 7. What this actually means if you're serious, not just watching candles. If you're serious about this and not just doom-scrolling price, here's what APMEX plus COMEX plus Shanghai plus Hekla are telling you. Physical is sticky, paper is slippery, boxes in the mail get delayed, contracts get rolled with a click. When both start to strain at the same time, the stress is real. Real buyers are already paying above screen. Whether it's Samsung, Hekla's clients, or Chinese industrials, the people who must have silver are paying what they need to pay. That price is consistently above COMEX and LBMA. Governments are picking a side. US and allies are not neutral referees anymore. They are building price floors and stockpiles. That is not bearish for an under-owned asset in deficit. Shortage over in one channel doesn't mean risk is gone. It just means that channel has caught its breath. Next pulse of demand hits a system with less metal and tighter rules than last time. If you're trying to protect wealth, the question is not, will silver be 70 or 80 next week? It's, do I believe the next crisis will be easier to manage for this system or harder now that everyone, miners, governments, industrials, and dealers, has seen what real demand looks like? Segment 8, outro. You've been watching John AG here, and I'm OG John AG. If this helped you see why one APMEX all-clear email, a 30% Hekla premium, draining COMEX vaults, and Shanghai's rule changes all point in the same direction for real silver, hit like so this doesn't get buried, smash subscribe with all notifications on, and drop a comment. Screen price or real metal, which do you trust? Tell me where you think the real silver market is trading today, not the COMEX number, the true clearing level, and what you're doing about it. Because on this channel, we don't just watch the ticker, we watch who can actually get ounces when the system is under stress.